All right, it's now 2 minutes past 3 UCT. We'll kick it off. So welcome everybody. I'm Jeppe Kirk Bonde. Tonight I'm running the Q4 22 quarterly conference call. If you want to use this presentation for anything, please go ahead and read the disclaimer here below. So the agenda for this presentation is that I'll talk a bit about my background, then about my investment strategy, then my current portfolio, and finally I'll go through the many questions that I've received in advance, and also I'll read out some questions and answer them from the chat. So the reason that many people are copying me on eToro is that since 2013 I've had an average annual return on investments of 25%, and that's really better than most good investors you could fairly compare with. I effectively am one of the few who had the high returns along with ARK and NASDAQ and so forth on the way up, but only the declines equivalent to SP on the way down. And that also means I've sort of moved further ahead. And then if you compare with sort of the volatility of the portfolio, it's also quite a good performance compared to the other big ones. I got my education back in the day in finance in my home city of Copenhagen. Then I started work as a management consultant, working mainly with valuations. So evaluating what is a company really worth. My clients were some of the largest tech companies and banks in the world. And then as I was doing this work, I was making more money than I was spending. And so I wanted to invest my money. Then I looked at what my pension fund and my bank were offering, and I was frankly very unimpressed. So then I decided, okay, I'm going to invest my own money. Then I compared the different platforms, and number one in my analysis turned out to be eToro. And so I started investing on eToro in 2013. And then that just continued to go really, really well. And then today, more than 20,000 investors copy my portfolio with more than $50 million US. So I'm the most copied on eToro. I don't do everything on my own. I have a few assistants that help me speed things up and move along. I have a good network of experts that I can trust. If I invest in something, it must be something that I'm either myself an expert on or know someone who is. Then I get really good support from eToro. So whenever I have any questions or concerns, then they're always really quick to sort of help me out. Then I have subscriptions to all the best data tools so that I can get all the best data automatically into my models. And finally, I'll highlight my three favorite experts, my three brothers. So one of them, he's got his degree in computer science, worked for one of the biggest tech companies with deep learning. One of them is an economist at the Ministry of Finance. And the last one is the CEO of a marketing company. So if I have any questions or concerns regarding these topics, then they are my go-to guys. My investment strategy is based on some principles that have been there all along and continue to be here. So I focus on macroeconomics, identifying what kind of growth rates I think different pockets of the global capital markets can have. I focus on mega trends. So these are trends that can grow by more than 10% per year for more than 10 years. And I focus on fundamentals. So that means conducting due diligence, really understanding the management, the employees, the products and services, the financial statements and so forth of all the companies. And that's with an eye on making a discounted cash flow valuation. So to understand, what do I really think this company is worth? Not what other people might think it's worth, but what I truly think this company is worth. And then I compare that to what the price is and invest in companies that I think are worth a lot more than they cost. I focus a lot on the long term, and that's the most sort of difficult one for people to understand, because of course, if you keep doing well in the short term, then you'll also do well in the long term. But in practice, history has shown that if you want to run a portfolio well, or a business well, or even your life well, you're better off if you focus on the long term. And that means that if something seems to be urgent now and seems to be important now, really understand that this is not something that will gonna matter 10 years from now, and you focus on the things that are gonna matter 10 years from now, then that overall leaves you in a much better place. It frees up your mind to focus on what's really important and ignore the noise, and then overall in the long term be better off. There's a great quote by Benjamin Graham, who was the author of the famous book, The Intelligent Investor, and also Warren Buffett's mentor. And he said that in the short term, the market is a voting machine. In the long term, a weighing machine. And that effectively means that in the short term, it can be important what other people think and what other people think that other people think and so forth. But in the long term, it's very hard for a stock to outperform the underlying business. If a business becomes very big and profitable and you own a large part of that company, you'll end up in a very good position. And I have the patience to wait around for that to happen. Then I focus on risk management. That means diversifying across different geographies and industries and business models. Many people think that they're well diversified if they just buy the SP 500 ETF, but that actually just gives you exposure to only American companies with a very high bias to the biggest ones, and especially tech. I have 61 different investments at the time, with the largest one taking up about 5% of the portfolio. And finally, I hedge against tail risks. So these are risks that are quite unlikely to happen, but if they do happen, they'll have an outsized effect. And so for each of those, I like to have at least one investment that I think could do very well in such scenarios. Then finally, I focus on keeping fees low. I don't use any short selling. I don't use any leverage. I avoid high fee instruments. I keep a low trade frequency. And of course, copiers pay the same fees as I do. So when I keep my fees low, the copiers keep theirs low. And that's just one more way to be able to squeeze out a bit more profitability from one's portfolio. Then there are some areas where I see great opportunities. I really like companies that have organic growth. That means they're selling more products, or they're able to increase their price, and ideally increasing it by more than the going inflation rate. But it doesn't include companies that are just going through acquisitions. So quite often you'll read in the front page of the annual report that, we grew revenue by 2% this year. And then, I can quickly evaluate, yes, that's correct. But actually that's just because you acquired someone. The core business shrank by 4%. So it's not actually very impressive what you've accomplished this year. I like companies that are resilient. That means they have a strong balance sheet, and it means they have some sustainable competitive advantages. That means that they will not so easily get dethroned, or if they're sort of on the way to the throne, they'll sort of not be so easy to knock off the path. Then I like companies that are profitable, that are creating real value, and ideally that can reinvest that extra positive cash flow they're yielding month by month into their own business to grow it over time. I like to invest in companies when they are coming up with a new strategy, because that often means you can invest in the company at the price of the old strategy and get the value of the new strategy. It's not enough for me that a company just says they have a new strategy. That happens quite often without it actually, leading to any change. So I need to see some sort of real steps that prove to me they're serious about this new strategy. So a company changing its name or divesting a big part of the business, something like that, that's something that tells me, okay, there's some things really happening here. Then you don't always have to predict the far future to do well with investments. Sometimes it's necessary but not sufficient part to be able to predict the present. A great example of failing at that was when Microsoft's former CEO, Steve Ballmer, he held the first iPhone in his hand. And he said that, it doesn't have a keyboard. It's too expensive. Business customers won't like it. I'm very comfortable with our position. And he was, of course, proven completely wrong by the massive success of the iPhone. But that was an example of holding the blockbuster product in your own hand and not being able to see that that's the blockbuster product. If you're a smart shopper, you understand why a certain product is better than another one, why a certain deal is better than another one, why that company's going to give you a great service and this one isn't. Then you can also evaluate companies to an extent. If you're not able to evaluate products and services, then evaluating companies is basically impossible. Finally, I like companies that are mission driven, not because I sometimes believe in the mission, but also because it's a great way to attract great employees and keep them without overpaying them. Some companies are just magnets for talent. The smartest, most hardworking people, they really just want to work there. And there are other companies where the opposite is the case. If a smart, hardworking person accidentally ends up there, then, within a short period of time, they just can't wait to get out of there again. And whether your company is in one camp or the other may not, showcase in the financial statements next quarter, but a few years down the line, it'll make a huge difference. Then my portfolio on eToro is primarily a stock portfolio. Now, I also have a property that I rent out, and having many of my copiers probably own a house they live in and are also building a stock portfolio. And this makes very good sense, because throughout the long history and the more near-term history, stocks and property have been the best asset classes. Bonds have been okay historically. They've not been so great in recent years. Even if you're making a certain interest rate now, if inflation is much higher than that, you're still earning a negative interest. Commodities have historically not been great. if you had a gold bar during the Roman Empire, that gold bar didn't give birth to any baby gold bars. It didn't earn you any rent. It didn't earn you any sort of, business profits year after year. You still just have that one gold bar. It's been better in recent years, but over the long term, not that great. And finally, currencies have historically been quite terrible. The worst case, of course, with Germany in the interwar period, where the Reichsmark lost 100% of its value over 2 years, or Zimbabwe in recent memory. But also the best currencies through history haven't done that well. They've been steadily losing out because the money supply keeps increasing, and that's basically a tax on the holders of currency. So whenever I have a lot of cash, I try to get it shifted left in this chart and ideally invest it into some stocks. Then the biggest factors that really drive world economic growth over the long term can sort of be split into the physical world, the social ideas, and the big technologies. So in terms of the physical world, it's quite important how many trees there are in different places, how much oil and gas, how much of different kinds of metals do we have in the ground where. Then life is important, animals, but also humans. How many humans do we have where? How old are they? How are the demographics changing? The companies that have the right products for the right demographic group in the right place, they are, having a clear advantage. Then the factors that can cause the most value creation or destruction in the fastest time frame are the social ideas. Whether you have a US dollar or a bond or a stock or a deed to a property, an old piece of paper that says that you own this property, these are all just social constructs. If we believe in these social constructs, they can help us cooperate, trade with one another, and that can help us create a lot of value and a lot of belief in future value. But if we stop believing in some of those social constructs, that value can dissipate very quickly. Then you have some things where people just think that it's natural that a house has value because obviously it's made of brick and mortar. But theoretically, if everybody wanted to live in tents, then houses wouldn't have any value. Maybe actually would have negative value because they're standing in the way of the beautiful views. And that's sort of, if what we value socially changes, then, the valuation of things can change. And that can happen very fast. And if some political or social change is coming at a great trajectory with a great percentage change per year, even if it's coming from, the margins of society at such a growth rate, it can very quickly come to suddenly be, something that's causing influence all around the world and is really, causing the change of valuations. Then the other sort of big category are the technologies. So the biggest ones are the foundational technologies, coming from the agricultural revolution to the industrial revolution, to the internal combustion engine, to electricity, the digital world, and, now moving into a deep learning, these sort of things that technologies that really change everything. But besides that, we also just have the small day-to-day innovations that people are doing in their own homes and in large companies all around the world, where, you don't necessarily notice it from day to day, but if you just keep improving things slightly, then over a long enough piece of time, you'll suddenly see things are very, very different. And vice versa. If you have a company that's ahead of the competitors, but the competitors are just slowly catching up, copying what they're doing, then, their lead will slowly fade away. Then from those big macroeconomic long-term drivers, we can sort of focus that down on how the world economy is faring today. So if we look at a GDP growth, it's come down quite a lot, and the world has sort of ground a little bit to a halt in most places. We're not in a recession yet, but a lot of economists and large banks and whatnot are predicting that we will head into a global recession in the next 12 months. So that's quite a dire outlook. One positive is that in America, unemployment is not too high yet. That's sort of giving the central bank at least a little bit of breathing room. But generally, unemployment is actually not that great. A lot of that's not just because of COVID. It's not just because of sort of recent events. It's just been structural problems in a big part of the world for a long time, and so that needs some sort of deeper fix. It's not just something that the central banks can fix in the short term. Interest rates have come up a lot, and they're probably going to come up by another 75 basis points in America tonight in a few hours. That's, of course, to reduce inflation, because inflation is way beyond all the targets. But if you look at what the market is predicting inflation to be over the next decade, it's not that bad, sort of, below 3%. So inflation is too high. and it's come in higher than expected for many quarters in a row. And that's, of course, sort of concerning, and something that all economists must take very seriously, because, if you keep making an underestimate of something, at some point you have to question whether your models are really correct. You should be sometimes you're overshooting, sometimes undershooting, and then, you sort of maybe have a model that's at least somewhat accurate. But if you keep missing to the same side, then there's a deeper problem there. Then there are some megatrends that I've identified as extra interesting. So if a company is riding on the wave up, then it's more likely to be found in my portfolio. I love the nice to haves. When we humans feeling good and safe and everything, and we have enough, then we can compete with each other on fashion. We can spend our time with our friends and family gaming. That's awesome. And there are great investment opportunities within these categories. Companies with great outlooks, great opportunities for high profits and growth, yet not that high stock prices. But without the need to haves, the nice to haves fall away. If you don't have security, if you don't have health, then you can kiss the nice to haves goodbye. And there are also great investment opportunities within those areas that fulfill those needs. Finally, there are the enablers and accelerators, the things that can make all of these things happen better, faster, cheaper. The companies that are really always at the bottom of those articles, they are to be found in the portfolio. And the companies bringing the next generation of the most advanced devices, they're also to be found in the portfolio. Then if you've identified a group of companies, some kind of ecosystem or an industry, you want to get a nice overview of the companies. A good way to do that is to look at the multiples. So this is an example of FANG. So Meta, Apple, Amazon, Netflix, and Alphabet. And if we start in the top left corner, we can see that all of them have very good profit margins, but Amazon's lagging quite a bit behind. In terms of growth rates, many will recall that all of these companies were a few years ago having double-digit growth rates. Now they've completely stagnated. Meta's even started losing out on revenue, thanks to them being really ad-driven and advertisers kind of cutting spending a little bit. Engagement is still fine, but it's certainly not the growth rate we were used to. And it must be said that if you are very big and profitable and not growing much, you're really matured. You might be called a mature company than not a growth company. The two top charts, the higher the better, because they're about profitability and growth. But the two bottom charts, the lower the better, because they're effectively about price. So in the bottom left, we can see that for every $1 of profit we are getting from Meta, we're only paying $8. Now, historically, across companies, that was 15. So usually through history, you've been paying like $15 for $1 of profit. Now you're paying only 8 for Meta. So, Meta can really afford to lose a lot of profit margin, lose a lot of revenue, and still be a good deal. Now, for Apple, we are paying 22. That's more normal. For Amazon, we are paying $91 for every $1 of profit. Now, we only want to pay that much if we believe they can improve that profit margin, or maybe sustain or improve this growth rate for longer or something like that. Otherwise, we wouldn't want to pay that much more. And then finally, in the bottom right, we can see that for every $1 of revenue, we are paying only $2 for Meta and Amazon. And of course, for Meta, we're getting a lot more profit out of that revenue. For Apple, we're paying $7 for every $1 of revenue. So that's certainly a lot more. But some might say that Apple's revenue is also much safer. They have a bigger moat around their core business, making it harder to dethrone them. And so you're paying more for that more higher safety of revenue. So that's effectively a good way to get that overview of an industry. Now, I usually don't look at charts as much as I just look at large data tables. They look a lot like this. And those data tables are either coming in automatically from my data providers, or they are made manually by me and my assistants with subjective insights, but numerical. So that could be something like, how nice is the CEO on a scale from 0 to 10? How nice is the website on a scale from 0 to 10? And then all of that data from the data providers, along with our unique subjective insights, is combined to all my valuation models to evaluate how much are these companies worth and how do they relate to one another in terms of risk. So can I construct a portfolio in some way that can give a higher return compared to the risk than the market average? All of those analyses are used to make decisions. So that's chiefly the research decision. So I do a lot of valuations, and that lead me to think, oh, maybe this company could be interesting, but I need to do more research on this company. And doing that research, I find that I need more data. Then by putting in that more data, that gives me insights about some other companies. Then researching these other companies, that means that I have to do some more data analysis, and then so forth. And that cycle of getting data, conducting the valuations, doing the research and so forth, eventually has to lead to the investment decisions. So that could be that there is a company that I'm already invested in, but I want to increase my position or maybe decrease it, or there could be a company that I haven't invested in yet that I want to add to the portfolio. And then when you take all those investment decisions and add them together, then you get to my portfolio. So if you compare that with the US economy, you can see that in the US, it's not just one industry that's having all the economic activity. There's economic activity across many different industries, and there are also good investment opportunities across many different industries. In my portfolio, it's also diversified across many different industries, but there's a slight bias with some industries taking up a bigger proportion. I have relatively more in tech, more in climate, renewable energy and green tech, more in health and biotech, more in metals and mining, and then more in financial services. And the three largest investments right now are in Centene, in Leidos, and in First Solar. And you can always see the entire portfolio on eToro and on the website or in the app. And that's my initial presentation. So I'll now move on to all the questions that I received in advance. And then after I've gone through them, I'll take some questions from the chat. Some of the questions are a bit long or winded, so I've just sort of rewritten them to shorten them a bit. So first question, what were the main changes to the portfolio during the quarter? In terms of price, the biggest changes have been that the technology stocks and the Chinese ones have lost a lot of value, whereas the sort of gains have come from industrials, healthcare, and the defense stocks. In terms of the companies making changes, a portfolio is sort of a living, breathing, evolving thing. Even if you hold on to the very same stocks, they will close down factories and open new ones, open up in new countries, fire entire departments, invent new products. And in terms of that, some of them have launched well-performing new products like the iPhone 14, or Meta doing a lot of work for the upcoming Quest Pro, Rheinmetall divesting a part of the business that I didn't like, that I was very, very happy to see go. Finally, I made some changes as well. I reduced my position in Nintendo and Corsair, thus bringing the sort of overall gaming exposure slightly down. And I added Tronox and Freeport-McMoRan to the portfolio, increasing my overall exposure towards metals. Then someone asks if they should copy open trades. So I would say, if you're gonna copy me on eToro, then in all likelihood, one should be copying open trades. It does not make much sense to just copy new trades, as most of the cash is just going to sit there idly waiting for those trades to be executed, and you're going to have a very sort of risk-wise strange portfolio. If instead you copy open trades, then you're going to invest in the same 61 assets that I'm currently invested in the same original percentages. And then, when I make a future trade, you'll make the same trade. And when I close a trade, you'll close that trade. When we receive dividends from those positions and I reinvest those dividends, then you'll do the same. And so that's sort of the way copy trading is. It's not, it's not that that's the way copying me is essentially meant to work. So I definitely think if copying me is most likely the case of, one should be copying open trades. Could you give your views about Meta? So I think I meant talk about the pricing. The whole company is now costing less than $300 billion, which is not much for having a sort of a deep learning leader company with such high positive cash flows and so forth. But it's effectively now two companies in one. One of them is the stable, no growth social media giant with the family of apps of Instagram and Facebook and WhatsApp. Living off of the advertisement revenue, and that one you can sort of value in a certain way. And then you got the other side of the business, which is the metaverse side, based off of the old acquisition of Oculus, which is effectively a move similar to how Apple back in the day created the iPhone to defend their iTunes market, because they could foresee that their great sales of iPods was going to get challenged from people listening to music on their phones. So Apple said, either we're going to lose out on our iPod sales to mobile phones, or we're going to enter mobile phones ourselves and cannibalize and disrupt ourselves before others do it. And that turned out to be an amazing move by Apple back in the day. And so Mark Zuckerberg's evaluated, we're going to make a similar move. We are going to front run this whole thing. We're not going to win on mobile. We are going to win on virtual or augmented reality by being the biggest spend on this, investing massively, bleeding hard on this for a long time, but potentially thus helping us to have the total vertical integration with device, operating system and apps on top of it. How do you then value sort of that side of the business? Well, there's the valuation part that comes from these synergies of the vertical integration of us defending the old social media profit that will not just be threatened by sort of Apple's changes to the App Store and TikTok and Snapchat and new regulations and so forth, but so you sort of got that benefit. But then the other thing is just look at Meta sort of, or the metaverse has business of its own. You cannot value it too highly, unfortunately, because you sort of got to compare it with other high growth bleeding companies. There is a big difference in valuation of a company that's broken even, that are not losing money, not gaining them, but they've sort of proven that this product can really sell. And Meta haven't done that with their virtual reality headsets yet. And so you sort of need to see that before, because otherwise you don't really know, are we talking about this taking 10 years, 20 years, 30 years, what's really the timeline here? And that can be a huge deal, that can be a multiple factor on the valuation based off of, how many decades you're looking at. And that's sort of some of my grand thoughts on Meta. Are you making changes to your valuation methodology due to the high inflation? So inflation's always been included in my valuation and risk models. So both, what is the inflation now, and also what is it expected to be in the future, and what could it potentially be? On some asset class, it matters a lot. On others, it matters less. One area where it's mattered a lot and matters a lot and will matter a lot is in bonds, because of course, if you can see a nice corporate bond that locks you in for an interest rate of 6% nominal, you're like, oh, 6%, that sounds nice, but that's not very nice if inflation's also 6%. Then you're making nothing in real terms. That's not very nice at all. So for those assets, they're ruined by the high inflation. And if inflation were to come down while interest rates go up, if you could suddenly start seeing some corporate bonds with a high interest rate in a low inflation environment, that would be a whole different deal. And then suddenly, I might add bonds to the portfolio to a large degree, but I don't think we're there yet. Is this year harder than other years? So in terms of making absolute US dollar returns, it's much harder. This year, the US dollar has really skyrocketed. So you can sort of think about for many different asset categories, if the US dollar is worth a lot more, and then your product is just categorically going to be worth less US dollars. So your company, your commodity, whatever, is worth less dollars, but those dollars are worth more. So when the US money supply stops growing, which it stopped, earlier this year, interest rates come up like this, and money becomes worth more like this. That makes it really hard to make a high return measured in US dollars. But then if you look at how the year has been in terms of relative performance, it's been, a very good year, because the competitors that I benchmark myself against, they've had a much harder year than I have. And so my the distance from me to them has increased a lot. And that's sort of been the big saving grace here. Are dividends shown on your profile? So yes, when you go on eToro and you are looking at different investors to see how they are performing and how they've performed historically, dividends is included in the number. So the 25% that I've yielded, that's including dividends. And more than half of the assets in the portfolio actually pay out dividends. Some pay out a very small amount, some pay out a large amount. And if you go into your own account statement, you can also see a full breakdown of the dividends you've received from the different companies. So, you can sort of track exactly how that's been going. Are we in a bull market, or are stocks just rising because of the election? So firstly, I think, it's this idea of we are in a bull market or bear market. It's always really something that people wrongly put to a time period in hindsight. Just because the market's been going up lately doesn't mean it's going to continue to go up in the next period. Just because it's going down doesn't mean it's going to continue to go down either, and it's not going to necessarily reverse either. That's just not, expectations get built into markets. If there was any sort of a big momentum of reversals just continuously happening, then that would have more or less already been picked up and just sort of traded out of the market. So I think when you are investing in stocks, I think now stocks are looking really attractive. I think many of them are able to, maintain positive cash flow even through a recession, maybe not grow as much, but sort of, if you look at the total lifetime of how they can perform at the current price level, I think they are very attractive. And then there's the question of, is it rising because of the election? there's always this sort of tendency in the news media to try to tie the latest market move to whatever news story is, happening right now. So you might have something like, oh, oil price went up because of increased risk of conflict in the Middle East. Or you have the exact opposite, oil price down because of increased uncertainty about the Middle East. And neither one is really the true case. It's also, if you have a big pile of straw on a camel, it's hard to identify which straw it was that broke the camel's back. So this sort of thinking of like, this thing caused that thing doesn't really work in markets, unfortunately. What happens if China attacks Taiwan? Firstly, I don't think that that's the most likely case at all. If it does happen, I've created sort of a whole range of scenarios for different ways it could occur. It's very important here exactly what time frame it's happening, because sort of the more time you give it, the more likely it is that everybody has built up some more resilience towards this. Then I think we have to appreciate that China is not some barbarian country that's just going to try to solve things with violence. I think, if you look at how America has performed in Afghanistan and how Russia is performing in Ukraine and whatnot, quite often you have an issue and there's no good diplomatic solution, but there's also no good military solution. And that can be very frustrating because you feel like, either a diplomatic or a military option should work. But sometimes it's just the case that neither's going to work. And then, you really have to ask yourself if you are well off to do something to disrupt the status quo. And I don't think so. I think if you look sort of back when this first hit the big headlines in the year, it was around Nancy Pelosi's visit to Taiwan. I spoke with a lot of my Chinese friends about this, and they thought it was a very big provocation. I sort of argued that it wasn't a big provocation. Maybe it was like in the grand history of provocations, a quite small provocation. China responded very fiercely with lots of military exercises and so forth. So sort of showcasing that, you cannot mess with us. And I think then if you sort of want to go into exactly how an attack would work out or whatnot, you can sort of extrapolate from how attacks have been on islands and coasts in the past, and then with the various technological changes that have been since the old days. But in overall, some of these scenarios you can use in case China attacks Taiwan are similar to just the general scenarios for if the world splits in two. So you could sort of imagine a world where instead of having one large global economy, we just have two different world economies that are not talking with each other, a big China bloc and a big American allies bloc, and then sort of a new effective Cold War where we just then wait and see which side can do better economically over time. And I think that, just really, really stupid situation to get into for everybody. Is it better to invest one large lump sum or invest a smaller fixed amount each month? So it sort of depends on your situation. Overall, in general, if you have a large amount of cash just sitting there, it's in almost all cases best to invest a large part of it into the stocks immediately, because on average over time stocks go up more than cash, and so the longer you wait, effectively on average the more you lose out. If you have a sort of higher income than your expenses month after month, quarter after quarter, then it can be good to just set every quarter a certain amount aside to invest in stocks, and then you just do that. And then over time, you build up that portfolio. And it can actually also have this sort of bonus benefit that it helps you to reduce your own expenditures, because for some people, if they have a very large amount sitting there in the bank account, they're more likely to spend it. But if it's invested in some stocks, then they're less likely to go out and sell those stocks to spend it. If you have a large amount of cash, it might be good to put a lot of it into stocks, but otherwise it's fine to sort of do it steadily over time. Does dollar cost averaging work in a bear market? So dollar cost averaging is effectively the second part of the last question. So slowly investing over time, and then, you do poorly on some of the market entries, but you do better on some of the others. And so the market entry timing risk is averaged out over the time period. But again, if dollar cost averaging means just leaving a large cash pile sitting there idly at a low interest rate, not getting the higher average from stocks, that may not be the ideal scenario. And with dollar cost averaging, when you are thinking about doing that, you should really get away from this bull market, bear market idea, because the whole point is averaging. That means that you are accepting that there's going to be good times, there's going to be bad times, and you are happy to take both of those. There's going to be years where the market cuts in half. There may be years where the market doubles. There could be years where down 20%, up 30%, and so forth. But when all of those are averaged out and the long-term returns prove out to be good, then, then you might overall be very happy that you got into this habit of investing steadily. That was the questions from that I received in advance. So thank you very much for everybody who asked those questions. And now I'll just go through some questions from the chat. So considering the political global situation, what are your thoughts on the Chinese market in general? Will you engage in it, or is it too risky to invest long-term? I'm particularly interested in the EV sector. So firstly, there is never a specific sector that on its own is too risky. It is very fine to take some extremely risky bets if this has only a 1% chance of working out, but it's going to pay back 1,000 times if it works out, then that's like on average a 10x of your investments. You should take those bets. I think it was Jeff Bezos who famously said, in Amazon, we are very happy to take those bets that will pay off at 100x, but only have a 10% chance of working out. But with those, you're going to lose out 90% of the time. That can be very painful. You'll be told you are wrong on these ones, but those have a very nice role in a portfolio. And so I think even if you think the Chinese market is dangerous and risky and whatnot, just having everything in the home market, that's also very risky. There could easily be a situation where, the world goes in a better direction. There's an easing of the geopolitical tensions, and, China decides to be embracing the world with open arms, and then these do extremely well. There is also the other side where we suddenly see a very, very sharp descent into decoupling, where we might see that some of these Chinese companies will no longer have the beneficial access to Western markets that they've been used to, and that can to some extent be fair. It's not really fair that TikTok from China is doing well in Western markets if Western social media companies are not allowed to get a chance to compete in China, for instance. So, then there can sometimes be the risk mitigation that if you're going to lose out a lot of money on one investment here, but all of that profitability goes straight to another part of your portfolio, then you're sort of, that's an overall lower average return adding it to your portfolio, but it's not actually that much riskier. So I do think that to reduce your risk, you do need to have geographical diversification, which includes having some markets that do have some specific threats involved. In terms of the EV sector, I think the total auto industry is heading in that direction. And I think some of them are quite cheap compared to their growth rates and profitability. So that makes them nice. But I don't think that they are the most interesting investment opportunities. And so it's not something that I've found space for in my portfolio. What about the Brazilian market? You showed it in the comparisons, but I do not know if there are stocks in your portfolio. Well, there is Vale, so the grand iron mining stock that's also mining other things there to be found in the portfolio. And of course, there are many companies that just have various activities in Brazil. So even though they might not have their headquarters in Brazil, they are doing stuff in Brazil. And in terms of the Brazilian market, I think that Vale is a really, really amazing company. I think they have great potential, and it's really a market that's always come with an unfortunate huge risk premium, because you sort of never know what the government's going to do there, and that's sort of that's always been sort of a bit of a problem. But I would never exclude other Brazilian companies. If you have an access to information common people don't, and can see how market will move, why not use this in favor and to profit by opening short position? Or is this too much risk? So in general, with short selling, many people think that short selling is, a great way to reduce risk in a portfolio. It's a great way to benefit when the market's going down. But on average, when you really think about it, stocks have historically gone up by 7% per year in real terms and 9-10% nominal terms. So on average, when you buy a random stock, you can expect to gain 7%. That's a pretty good deal. But if you're shorting a stock, on average, you're going to lose 7%. That's the average base case. So you got to be really good time and again to actually make money shorting, because you are, really fighting an uphill battle when you're fighting against an average of 7%. Then on top of it comes the fees. And then comes the worst part, which is that when you are investing in a company, there is something called limited liability protection. If a company's stock price goes to zero, that's it. That you lost the value of the investment, but no more. That's the protection. But for a short position, it's the opposite. If the stock goes to zero, then you might have doubled your money, but that's the maximum you can make. So there is a ceiling on how much you can make, but there is no limit to how much you can lose. If you've shorted a company and this company, invents the cure to cancer, or they suddenly have the breakthrough of general AI or something like that, or a lot of people on Reddit decide to go and bid it up, then there's no limit to how much you can lose. On one short position, you can lose your entire portfolio, but on one long position, you can't. But that one position, if it's the right one, could suddenly massively increase the value of the whole portfolio, which a short position can't. So with that whole case, I'm just not going to do any short selling. Now, if everything changes, if the fees change, if the outlook for markets change, or if, limited liability reasoning changes or something like that, then it'll be a different world. Then I might change my view on short selling. But until then, I will not, and I don't think it's very likely that I'll be starting to short sell anytime soon. What will be a strategy in a prolonged recession scenario where basically the indexes stay at one place for years? So if we start to get the outlook like, wow, we are going to be in a recession for a long, long time, then there are, some companies whose products and service will just not be in as much demand. They are going to not see the kind of profit margins that they would be hoping for. They are not going to have the growth rates they were hoping for. So I would be less willing to pay much for those companies. And so if the price doesn't come down, compared to that, then they would find less space in my portfolio effectively. And there could still be somewhere a bad few years because of recession is simply not enough to change the case. If there is a company that I think is in pole position to capture a huge future global market, but it's going to take 20 years, but then after those 20 years, the $1 trillion valuation is going to come, then it's not going to matter to me whether they have, a 5% positive cash flow over the next few years or a 1% positive cash flow. That's something, many other investors might look very hard at saying, how come I didn't get my positive cash flow last quarter? Where was the dividend the last half years that I was expecting, and so forth? But, some companies, the majority of the value really rests far out in the future. And for those, it really shouldn't matter too much how the economy will fare in the next few years. It's sort of equivalent. You can think about it in terms of if you're buying a beach house, you're not just buying that beach house to use it for the next few summers. You're not just renting the beach house. When we're buying a company, we're not just leasing it for a few years. We now own that company. We own those assets. They're ours for eternity unless we sell them. So that means that even if you are going to have an expectation that, it's going to rain the next few summers, that's perfectly okay if the weather's going to be great all the years after that. Then you don't sell your beach house at the beginning of every summer because it's going to be raining. Also, those forecasts are publicly available. So unless you have a better weather prediction, then you don't have any advantage in terms of buying or selling beach houses. And it's sort of the same. If everybody knows that there's going to be a recession and everybody knows there's going to be less cash flow for these companies for a few years, then you should also expect them to be trading slightly lower. But then if you have a different valuation for the long-term potential, then that might be why you choose to hold on to them. What is your profit loss expectation in your portfolio ending 2022? So I sort of don't really do short-term price move predictions. When I invest in a company and a portfolio of companies, it's because I evaluate that these assets are worth more than their price based on all of my analysis. And I don't expect that over the next few months, we only got 2 months left of the year, that others are going to suddenly manage to repeat all of my analysis and come to all of the same conclusions and bid up everything that I've invested in. There might be any number of things happening that could swing it hugely upwards or hugely downwards, but base case is that it's going to go up a little bit and will recover a little bit. But there is such a huge volatility around that base case that it's not really the most important bit. A lot of people, they want to sort of know, like, is market going to go up or down right now? But over a long time horizon, what's more important is sort of if you had the right assets that went up and down, but overall went up more than they went down, then that's created the biggest sort of piece of value. The people that are like shorting the market now because they think it's going to go down, and then they're going long because they think it's going to go up, and like if they are the smartest investors in the world, they're still not correct often enough to make up for the average loss on the shorts, that they're overall, doing well. So if you look at their returns over long time periods, those kind of investors don't have the highest returns. The sort of investors that focus on the long term, build a portfolio based on fundamentals, and accept that there is a lot of volatility around that, they are the ones that you find decade after decade in the top of the charts. So that was all the questions in the chat. Thank you everybody who watched here tonight. And if you didn't have a question and you maybe later on you remember a question, then you can always comment on any of my posts on eToro, or you can add me and write to me on LinkedIn, or watch some of my other YouTube channels and so forth. So with that, thank you everybody very much for participating, and yeah, let's have a great next quarter.